Hello, everyone, and welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Brian Rogers, and welcome also to Investor Education Month at TD Direct Investing. We're dedicating the entire month of October to helping investors seize the opportunity. So, the opportunity that's present no matter the market conditions. We have a ton of free educational events throughout the month, so check out our full calendar of events at td.com/IEM. Now, speaking of opportunity, I think it's safe to say that we'd all like the chance to enjoy a comfortable retirement. And dividend investing can be one way to help investors get there. The idea is to invest in dividend paying investments and then continually reinvest the income received from those investments into buying new shares. Over time, the dividend income can grow into a monthly sum that the investor can live off. Now, the end result may be the same, but there are many different ways to pursue dividend investing depending on an investor's needs and goals. So we're going to speak with three investors who have used very different approaches to reach their retirement dreams. Joining us is Adrian Starinieri, founder of the YouTube channel Passive Income Investing, Henry Mah, founder of the investing blog Your Ever Growing Income and author of several books on income investing. And then we have Mark Seed, founder of the personal finance blog My Own Advisor. So I know I've met all of you before and seen you on other webinars. I want to say welcome and thank you for coming back to the show. All right. So, okay, one last thing before we dive into our conversation as well, though, is we'll discuss the ways each of our panelists use dividend investing to help them reach their financial goals. However, everyone's financial circumstances are unique, so they may not make sense for all investors. So take what worked for our panelists as food for thought in your own investing journey rather than explicit financial advice. So we're not going to be providing any advice today, or don't take it that way. So with that said, let's learn a little bit more about our panelists. So I've got some questions, and once again, as I said, I'm excited. I've had all of you either on a webinar or watched webinars that TD's hosted, and I've checked out your blogs, and there's lots of great information. Before we jump into the questions, how's everybody doing in terms of your regular life? I know. Let me know where you're at and how everybody's doing. I'll start with Mark.
Yeah, thanks, Brian. Great to be back, and nice to chat with the fellow panelists tonight. I'm based out of Ottawa. I've lived here for many years now. I'm rocking the sweater. It's not quite golf weather anymore, but hopefully get a couple more games in before the end of the year.
I know you like your golf, Mark, so I figured you might be out there today, but you're here today, which is perfect.
You got it.
Glad you're here. And then Henry, what about yourself?
Hi. Well, I'm the old guy from the group. Staying at home, taking care of everything. Things are doing well. Unfortunately, I'm unable to travel anymore, so I've sort of stuck at home. That's why I spend most of my time on my blog, looking for things to say.
Awesome. Well, no, I know our people are going to enjoy that, like enjoy looking up your blog and enjoy what you posted there. And you're an author too, so you have most of the wisdom. You're the old guy, but you're the wisest, right?
I think I have to give more credit to my daughter than myself for being the author. I think the first time I wrote the book, she read it, and I think we scrapped it within 15 minutes. I had to start all over again.
Oh, nice. It's good to have somebody to review that for you. That's amazing. That's perfect. And then Adrian, I'm going to ask you a question here in a second, but how are you doing, Adrian?
I'm doing good, Brian. Thanks so much for having me back. It's good to be back with you, my friend. Everything is great here. The sun is shining in Panama, and excited to talk about everything with you again.
Nice. That's an interesting thing. Right? For those that may not know it, Adrian, if you haven't checked out his blog or anything like that, he is retired early in Panama. So part of his dividend investing helped him do that for sure. So I have a question for you, though, specifically for Adrian. So dividend investing has helped each of you achieve your financial goals, but your investing styles are each quite different from one another. So Adrian, would you describe your approach?
Yeah, sure. So I have really an income-focused approach. I would say the objective, or the primary objective, is really to maximize the passive income that you generate from your portfolio every single month, with the ultimate goal is really to reach financial independence as soon as possible. So personally, my priority is really generating cash flow that could fund my early retirement lifestyle, my quality of life. So I invest in high yield income funds, mostly ETFs nowadays, that really do hold mostly blue chip dividend stocks or blue chip non-dividend stocks, or simply that track indexes like the TSX 60 or the S&P 500, etc., and use income enhancing strategies like covered calls, like some modest leverage as well. So they provide high monthly distributions that are fairly consistent. So that's how I would describe my style and approach. And I'm always trying to continually grow my passive income each month by investing regularly and really reinvesting all the excess income that I earn every single month, which I think is a good practice no matter what style of investing you do, whether it's growth, whether it's dividend, whether it's income. You always want to try to invest as much as you can to really grow your portfolio over time.
All right, thank you for that. We're going to dig into your approach a little bit more, but sounds like if I could summarize really well too, is the fact that you're using funds, not necessarily picking a individual stock and looking for that yield, or just a book of individual stocks. You're looking more for ETFs, exchange traded funds, and other funds that way. Is that right?
Yeah, yeah. I typically stay away from single company, single stocks. There's a relatively new income-oriented product that have come out recently on the U.S. and Canadian market too, where they do income-enhancing strategies like covered calls, and leverage on one single stock. So maybe a tiny bit there, but I would say like 95% plus is in funds. So whether it's funds that hold a basket of 30 stocks, 50 stocks, or really funds that track indexes, like the two I mentioned, primarily I try to stay away from stock picking. We could talk all about that, but I've got burned in the past from stock picking, single companies that have high yields. We could talk about that later. So I try to stick with ETFs and funds nowadays for sure.
All right. Yeah, there's going to be different ways of thinking and perspectives on this panel. That's why I love this, because there are so many different ways to do it. So that's one from Adrian on using those funds. How would you say your approach to investing has helped you and your wife, Erica, reach financial independence before your 40th birthday? That's pretty impressive.
Yeah, yeah. So our goal, our ultimate goal when we discovered this, way of investing was really to reach financial independence as quickly as possible, to really get that freedom. So this was just the investing strategy that I discovered that would help us get there the quickest. So our intention really with these investments is simply to hold them for the long term and really live off the income. So, not touch the capital, only live off the income rather than investing, try to grow your portfolio numbers wise over time and then sell, some shares every month to support your lifestyle. For us, we're way more comfortable investing into this kind of portfolio and just living off the income, living off your interest, essentially never touching the capital gives us peace of mind. So our story is, and we talked about it on the last video as well. We aggressively paid down our mortgage in 7 years, from 2011 to 2017 or 2018. I might have my years mixed up a little bit, but pretty much that. And because we weren't really focused on investing at that time, was just doing it for fun, experimenting. So yeah, that's one very smart thing that we're happy we did, right? Pay down our mortgage very, very quickly. But after it was finished, we had a lot more disposable income, and that's where, okay, let's start looking into what we're going to do with this disposable income. So that's when I figured out and started finding these income oriented funds and started getting into, more the higher yield stuff. We quickly reach $1,000 a month in passive income. And after a while, we just crunch the numbers, and math doesn't lie. That's one thing that'll never lie to you. If we sold our condo, which was paid off, and invested all, how much could we potentially gain every month? And we figured it exceeded our monthly expenses. So that's exactly what we did. We sold our condo at the end of 2019, invested all the money in a mishmash of high yield funds back in November 2019. And here we are.
All right. And you can probably see in your YouTube videos, can you see like a nice scenery in the background in Panama?
Well, I typically film them in my office, which is here, which is closed off. You don't see it, but once in a while, I'll maybe do a short or I'll do a video on the balcony where you have the ocean view. We have a really, really nice view in Panama. Yeah. So I try to do them once in a while.
All right. Well, so that sounds like a good foundation that you established, for generating income. Thanks for sharing that, Adrian. I want to move over to Henry. Henry, so you're also very focused on income yield. So those that may not know, that yield meaning like this is the dividend amount you're getting from either the investment or the company divided by basically the price. There's a certain percentage. A lot of times you're going for 5% or 6% or whatever yield you're looking for. But you prefer individual dividend paying stocks. How does your approach work?
Well, first of all, looking back, it's hard to believe I've been investing for 30 years, even though I didn't start investing till I was 50. But when we began, we really didn't understand a lot about investing, and we just bought stocks with the generating a gain and then selling for a profit and then reinvesting and starting over again. And fortunately, after maybe 4 years, we finally discovered dividend growth investing through Tom Connolly. And even then, we found that we were still concentrating on capital growth. We liked dividends, but it seemed like the ultimate goal was still to generate capital gains. And it took me some time, because as I started to concentrate on the income that our investments were generating, I began to realize that I could generate more income if I concentrated solely on the dividends and generating more income from all of our portfolio, our entire portfolio. And that's where I started to change the name from dividend growth investing to income growth investing. And it really didn't happen until I recognized that we had to stop watching the price of our stocks. And as soon as I realized that I didn't care whether the price of our stocks went up or down, or if I was losing money on our investments, as long as every penny that we invested was generating an income, a growing income. And from that point on, till we reached age 65, that's where we began to really grow our investment income, because we totally ignored the stock market. We ignored all of the noise, the economic situations, and just concentrating on generating income from our investments. One thing we did avoid was high yield. I don't associate high yield with any stocks I invest in. And I guess the changing point was when we began to recognize that following the process of investing in quality dividend growth stocks. And the first thing we did was to try to find an easy way to identify quality companies. This next thing was, how simple was it to evaluate those stocks? To go back and recognize or review 15 or 10 years of dividend history. And by doing that, we came up with a process where we eliminated the vast majority of income-paying stocks, dividend-paying stocks, and we concentrated on what we considered the best of them. And it narrowed down to probably 15 to 25. In the beginning, we were holding more investments. We probably had about 23, 24 companies. But once we started investing in just those companies, we realized we didn't have to look at any other stocks. In other words, at the end of each year, or whenever we had money, we didn't have to go out and look for where do we invest our money. We just selected from those 20, 25 stocks on our list. And the next step was, when do you know which stocks to buy and when? Because that's really, and of course, I guess the final thing is when to sell. That seems to be the big hurdle for most people, is when do you buy a stock? And, which one do you buy? And of course, when do you sell? Well, um, again, we realized that it was so simple. The process to make those decisions was extremely simple if you concentrated on the income yield and ignored price. And so really the decisions of which stocks to buy, well, you buy from the list of stocks that you evaluated and narrowed down to the ones that you like the best. As to when you buy, well, we use the our Excel worksheet, which is the yield difference worksheet, which tells us which stocks are undervalued, uh, currently expensive, or reasonably priced. And the idea, of course, is to buy the ones that are reasonably priced, or if they're undervalued, provided the company isn't in trouble. And so that's really how we started with the process that I outline in my books, and that's really the process that we followed during retirement. Is that every investment must generate an income, and the income must grow over time. And we've consolidated our investments. We're now down to 12 stocks, and I don't think I've sold a stock in the past 10 years, and we've owned most of these stocks for 15 to 18 years. So,
well, I think
our
our
process.
audience would really appreciate that simplicity, Henry. Like, I love that explanation. There's that difficulty of timing the market and being worried about that roller coaster, the up and down, and figuring out what security is there where you can find securities that have paid or investments that have paid dividends for a long time, and all you're worried about is just hopefully that increasing dividend. I've heard you say that before. I had one other question just related to, I know you said you started earlier, or I mean later in life in terms of investing. It wasn't until around your 50s that you started focusing on the investing, but you did retire still around age 65. How did your style of investing help you make up so much ground?
Well, I guess I kind of might have misled some people because I did retire at 65. In other words, I stopped working, but we continue to work part-time, but by providing remote internet access to our clients. So even when we were down in Arizona, they could contact us, and then we would access their computer directly online and do whatever work they needed done. So I continued to work part-time really till I was about 70. But we did retire at age 65, and by age 65, we had generated probably about 40,000 of dividend income at that point. So when we added Canada Pension and Old Age Security, we really had enough to live on at that stage. But we weren't drawing down any of that dividend income. We continued just to reinvest all of our dividends. We continued to add money to our investments till we were probably in our early 70s. And of course, by that time, our income had doubled our annual expenses.
Okay. No, that helps. Thanks so much, Henry, for giving us a better picture of that. And we're going to get back to you on some of your strategy as well. We have Mark coming last because he kind of describes himself as a hybrid investor. So we've got Adrian talking about the funds, and then Henry saying he's down to 12 stocks, and it's more of a smaller selection of dividend paying stocks. But Mark, you've described yourself as a hybrid investor. What do you mean by that?
Yeah, thanks, Brian. I mean, I definitely appreciate where Adrian's coming from, because certainly when you're thinking about, living off the income or the yield, if you will, from the capital, that is absolutely appealing, right? And certainly we'll talk a little bit more about probably pros and cons of that. And then, I also see, the benefits of what Henry's doing in that, he's focused on a concentrated pool of, I think it's 12 stocks, right? In terms of companies that have paid as he coins it, almost like an ever-growing income, right? And so, my approach is a little bit different in that. Yes, I try to take a little bit of both worlds, right? So I invest in a collection of mostly Canadian dividend-paying stocks. I've long since kind of unbundled my Canadian mutual fund or my Canadian dividend fund or dividend ETF, and I've just held those stocks directly for income and price appreciation. And then, I recognize that it's a huge investing world out there, right? And Adrian kind of alluded to it a little bit in that, is there really a lot of value in trying to figure out, which potential company from this country is going to be a high performer or not. I've kind of reconciled my fact that beyond a couple of U.S. dividend paying stocks, ones that have kind of consistently grown their dividend over the last 20, 30, 40 years, I'm just better off in kind of investing in the whole world of stocks that is through a global ETF or a couple ETFs. So, I've decided to invest in a bit of a NASDAQ tech ETF because the growth has been there. Hopefully it'll continue in the future. But if it's not, I'm also, owning a global ETF that owns a world of stocks, 9,000 stocks. And so I don't have to pick and choose. And I'm always going to get that long-term return. So I feel honestly through hybrid investing, I'm getting the best of both worlds. I've unbundled for the most part my Canadian ETF for income and growth. And then just because I know it's a huge investing world and Canada is only 3% or 4% at best of the global market, I can largely index invest the rest. And so it's very simple what my approach is. I've written about it on my blog, I think for the better part of 15 years. And so far so good with the results.
All right. Well, I know I've checked out your blog before, and you and I had done a webinar in the past, Mark, and I just read today. It was pretty interesting. I love acronyms, like working from the bank. I think we get an affiliation for acronyms. But you had one on there, it was TULF, so TULF. Kind of like rhymes with golf. Maybe you did that on purpose for for that. But what does that mean?
Yeah. So I mean, simply put, when we look at the collection of companies that really drive higher earnings per share, tend to grow their dividend in Canada, I think you can kind of narrow down your potential stock selection into like 4 kind of themes, right? And I've kind of coined it TULF, and I wouldn't be the first that coined this. This goes way back, and Henry's probably nodding and smiling because I think Tom Connolly may have written about that on his site many moons ago. But the essence of that is T is for telcos. So telcos can pass some of their inflationary factors on to the customer. We know the names in the Canadian space, the biggest players. You have U for utilities. Utilities tend to be very stable dividend payers. They tend to be very stable. Earnings come from utility companies. And again, there's inflationary factors where they can pass those kind of inflationary concerns on to customers over time. Then you have the L for lower yielding dividend paying companies in Canada. So, you have railroads, you have some other types of companies in Canada that don't provide high yields per se. They offer price appreciation, and so I don't think it's certainly good to ignore capital appreciation and price appreciation. But they also pay a dividend. They also pay a fairly juicy growing dividend. maybe in the range of 5 or 10%. And then finally, you have F for the financials, and we have the many of the Canadian banks that have been the rock of our Canadian economy for a long time. But you'll also have life insurance companies and some others in there, alternative asset managers as well. So TULF really stands for telcos, utilities, lower yielding companies that offer dividend growth, and then the financials. And when you actually look at the Canadian conglomerate of companies in that TULF sector, you're going to find some really popular names. So yeah, TULF. Golf.
All right. No, it's a good place for our audience to take a look at that and remember it for sure.
Absolutely.
Well, thanks so much, Mark. So I know early retirement, I've heard this. I've heard a little birdie told me early retirement is just around the corner for you in 2024. Congratulations.
Thanks. It's coming along.
How would you say your investing style helped you get there or to this point?
Yeah, I mean, I've come up with, Brian, I think we talked about this in one of the other webinars, like this whole Phi Woot, and Adrian kind of hit on this whole, his goal was to really, double down on the debt and really hammer down on his investments and his yield strategy to help meet his goals. So, I kind of come up with a moniker of Phi Woot, financial independence, work on own terms, just because I don't want to stop working. I think, Adrian will maybe speak to this later. He's still doing his thing on YouTube, and he's passionate about investing. Goodness, Henry's still writing books and doing all the things he wants to do with his blog, and now in his 80s. So, Phi Woot is really about, financial independence, but I want to work on my own terms. I hope to work part-time. I really enjoy working with my current employer, to be honest. I like working and doing the blog stuff. I have other kind of entrepreneurial ventures on the go and stuff. So, Phi Woot really resonates with me, and hopefully in 2024 I can kind of do a mix of that, right? I can achieve my financial independence goals with my wife, but at the same time, we can kind of both work on our own terms, and hopefully those days are right around the corner.
All right, I like that. That's another great acronym. I think we can adopt that one. FIWOOT. So financial independence, work on own terms. All right. So thank you so much for that, Mark. I don't want to leave your other guys sitting there and waiting to jump in. We want to hear from you some more as well. Adrian, what would you say are some of the key benefits and risks with your approach to dividend investing? So what would be the key benefits and risks?
Well, when it comes to the benefits, there's so many of them. I mean, I don't need to pick individual stocks. I don't need to research them, take the time to research them, have the skills to research them. Individual stocks, you just never know what could happen. Yes, you could, choose really, really good, high quality dividend stocks, but the dividends are never guaranteed. You just never know. I had personal experience with this. I started with investing in many single stocks, single companies, and REITs, a lot of single REITs. I thought, hey, real estate, income, real estate, what could go wrong? But in 2020, a lot of these single stocks that I had, a lot of them reduced their distribution or cut it completely. So this is why we prefer funds that use option strategies like covered calls, because covered call income is pretty much infinite and is much more guaranteed than dividends, in my opinion, right? Dividends are basically based on a company's profits. So they need to stay profitable and keep growing their profits if you want to keep growing your dividends. Options income is just based on the stock's volatility and liquidity. So as long as the stock is listed and there's the options market, you're always going to get that income, even though the premiums could vary based on volatility, but it's not based on the company's profits. So another benefit is that if you're going with more fund approach, is it helps you diversify very easily. It helps you lower the impact of potential issues with any one company. No matter how good the company is, I always want to eliminate the single point of failure and focus more on diversified funds that hold many stocks. Just like a growth investor would rather choose a Nasdaq and S&P 500 index over a basket of choosing 15, 20 stocks. So that's pretty much it. I mean, in terms of risks, I mean, I am willing to sacrifice potential of higher returns for a more stable source of high monthly income to support my lifestyle. So covered call ETFs tend to underperform in bull markets, and there's more bull markets than bear markets, right? So you will pretty much underperform the indexes or the underlying whatever's in the portfolio. So, but personally, I think investors obsess too much over total returns. That's just my opinion. For me, quality of life, freedom, financial independence, much more important to my wife and I. And we could spend a whole hour to talk about the benefits of financial independence, financial freedom, actually achieving that in your 30s. I go to bed whenever I want. I wake up whenever I want. I don't have to ask my boss to reserve which 3 weeks of vacation I'm taking this year. I don't have to, if I'm sick, I don't need to, like I am now, I'm actually I have a cold. I don't have to call in sick or worry about taking a sick day. I don't have to travel to the office every day. I don't have to worry that my job is safe. Like today I woke up at about 10:30. I walked to the balcony, enjoyed the ocean view while having my coffee. I don't have to worry about getting to work on time or attending useless meetings. So for me, freedom, quality of life, peace of mind in my mind and my soul is really the ultimate total return. That's unfortunately something that can't be translated into a number or a total return number. And I think many investors don't think of that, and they should.
And I think there's a lot of other factors, like you said, your comfort level with risk and the amount of work you want to put in and things like that. Like you don't have to be a options expert to do the covered call because you're doing this in a fund. Would that make sense?
Just like I don't need to be a mechanic to drive a car. Exactly. I know the basic outline and it brings me from A to B, but I don't know how to take apart an engine and put it back, but I could still drive a car, right? So it's the same concept. Yes, you're paying that management fee. So the fees on these types of funds are higher than index funds for sure, because there's much more work that goes on. Just like you could select dividend stocks on your own, like Henry's doing, or you could just buy a high dividend ETF, which has, the fund manager will select all the best dividend stocks, right? Well, this is kind of the same thing. So instead of you buying the stocks, writing your own call options, doing your own options, or just buying an ETF. You're paying the fund managers to do it, but it's a lot more work than just stock picking. So the fees are a little bit
All
higher,
right.
and that's another factor on why it's possible they underperform the indexes. But for me, it's well worth it for the reasons I mentioned.
I like it. I like that mechanic analogy. Speaking of which, I know our audience would, if they're interested in your strategy, what sort of investor do you think might suit your particular approach?
Well, it's definitely people who prioritize income and cash flow, right? So it's people who are just trying to create another source of income for whatever reason. So it's really someone who wants their priorities to maximize their passive income. It could be to build another income source for security and to hedge against a job loss or an emergency. I mean, imagine if you lose your job, you have an emergency, and your portfolio is making you $500, $1,000 a month. Well, it could be a game changer, right? It could really relieve some pressure. So also people whose number one priority, if your number one priority is financial independence for whatever reason, doesn't mean you don't like your job, but there's a big difference between having to go to work and wanting to go to work, right? So maybe you have other dreams and projects you want to pursue. If you're entrepreneurial, like my wife and I always were, always trying different things, right? You don't need a job if you're financially independent. It's really a game changer. Doesn't mean you need to quit, but going to work because you want to versus you have to is huge, right? For retirees, very popular with retirees, these kind of funds, because most of them have, substantial amount of wealth. They want to turn their wealth into a cash cow machine to really enjoy their life to the max. But there's also other young people in my community who invest this way to build another source of income, to pay some bills. It motivates them to keep going, not squander their money, because now they know how to invest it instead and how to increase their passive income stream. I mean, for example, a student that I met at a Blossom event in Montreal told me he invests in these high yield funds. He's a very young guy because it gives him a small source of income, an income stream that helps him cover his costs of living, his school stuff when he's at school. So there's a million different ways you could use this investing style, but it's for primarily people who really want to maximize their passive income.
All right. Yeah, there's so many different circumstances for everyone, but just that passive income can provide that freedom. So, yeah, thanks so
Yeah.
much, Adrian. I appreciate that. Now, Henry, I want to go back to you, Henry. Same question that we had earlier. I'll repeat it. Is what are the potential benefits and risks with your style of investing?
Oh, I think the benefit to me is the simplicity of it. And some people might doubt that because most people believe that investing is actually quite complicated and very difficult. And like Adrian said, people are concerned about stock picking when you say you only own a few stocks. But really, the income growth strategy that I've outlined is probably one of the simplest and easiest strategies to follow. Because first off, your ultimate goal is to earn an income from every dollar you invest. And when you do that, you can ignore the fact that you invest, say, $1,000, but tomorrow it drops to $800. Well, as long as you continue to receive your income that you expected when you invested that $1,000, you can ignore the value of your investment. And that really means that you eliminate market risk. Market risk is the fear of losing money. But if you're not concerned about the value of your investments, then market risk or risk tolerance really doesn't come into consideration. And if you don't care about market risks, then suddenly you don't care about diversification. People diversify, or they recommend that you diversify in order to minimize risk. Well, again, our intention is not to be concerned about the market, but our income. So once you eliminate diversification, you no longer care about asset allocation. We're only invested in one type of asset, quality dividend growth stocks. And then you have no need to rebalance. And once you ignore asset allocation, you also get rid of fixed assets. You know, I want to invest for a growing income, not a fixed income. And especially now that I'm retired, why would I sell any of my investments that are providing me a continuous growing income for a fixed income, regardless how high the GIC rates are? Because, you know, they might not be that high a year from now or 2 years from now. Whereas my income has continued to grow throughout my entire retirement. And then finally, uh, if you follow the strategy and you're fortunate enough, or you invest sufficient funds over your lifetime and you earn enough income to retire on, generate enough income so you can live off your dividends, then suddenly you're not concerned about withdrawal rate. My withdrawal rate is 0. People talk about a 4% withdrawal rate. Well, I don't care about that because I don't need to sell capital unless I want to. And then the last point is that if you're living off of your income, then you'll never outlive your investments. And so, you know, once you reach the stage of earning sufficient income to cover your retirement expenses, then you can ignore all of those concerns that most investors really worry about. So I think that's the biggest benefit of, of what I call income growth investing. And again, as Adrian said, the only risk that we have is that a company will cut their dividend. But, you know, if over your accumulation phase, if you spread your investments over 15 or 20 quality companies, well, you know, over time, the longer you own quality dividend growth stocks, the safer they become. I think Tom Connolly has a phrase that they become bona fide, and they really do, because you know, you earn so much income from them that even if they cut the dividend, they're not going to affect your overall income generation.
Right, and I think I've heard you say too. A lot of those solid companies, they may hold the dividend, and oftentimes they're not getting reduced. Most of the time, they're getting increased. So you know, it's pretty rare where you may have one of those stocks that you researched well, and that you figured out is a solid, you know, consistently.
Yeah,
Uh,
income growth isn't dependent totally upon dividend increases. Certainly, that's a big portion of it. You know, but really, if you're reinvesting your dividend, you know, like in the market today, people are saying, well, the market is down, has been down for the last year and a half. Well, that means that even if you're not adding funds to your investment like I am, every dividend I reinvest buys a lot more shares than it did a few months ago. So I'm earning more income even though the market is down.
yeah, you're buying it on sale too if you're reinvesting.
Exactly.
Well, one thing I've heard you say as well, Henry, is I've seen it on your blog. I really like how you described, you know, Benjamin Graham talked about Mr. Market, who's very temperamental and kind of moody and things like that. Where you have, you know, I don't know if you made that up. I think you did, but there's Miss Income, and I really like that analogy where Miss Income is, you know, more
Yeah.
consistent and level-headed, and you know, continues to over time build on your investment. Where Mr. Market is always up and down. So I really like that analogy. So if anybody wants to check it out, take a look at Henry's blog.
Thanks, Brian.
Um, Thank you so much for answering that, Henry. I had one other quick question, same one that I had for Adrian as well. Is, you know, which sort of investor might your approach appeal to, in your opinion? Sounds like you said simplicity earlier. Is there anything else you would say?
Well, you know, I think an investor that is looking for a simpler way to invest and a more secure way to invest. You know, if you know that you'll generate an income from every dollar you invest, and you don't have to worry about market fluctuation, or you don't have to worry if there's a market crash, your income will continue to grow, then, you know, that's pretty appealing.
Well, now I want to jump to Mark really quick and give him a shot. I know, Mark, we're putting you at the last here, and you may have to make up some stuff on the spot if they've already said what you were going to say. But what would be the possible benefits and risks with your approach?
Yeah, so you know, I echo a lot what Henry rounded off, what maybe 8 or 9 points in terms of the benefits, and I would echo a lot of them. I mean, certainly the income from the stocks that we hold, they're never guaranteed. Adrian's point, but at the same time, you know, a collection of these companies is bound to accelerate and grow your wealth over time, right? So through the income these companies provide, the reinvested dividends, the fact that you're investing more money in these companies over time, just like a total return strategy, by and large, the collection of companies that you're investing in should absolutely build your wealth. I think one thing to be leery about a little bit in terms of the direct investing in companies, or certainly any individual company, is things can change, and so earnings per share can change. The earnings that the company provides can change. The dividend can potentially fluctuate. It may not grow. It could be stagnant depending on pandemics or other foreseen kind of black swan events. So I do echo what some of the other panelists are saying, but I would be cautious to say that focusing on only yield income, it's not necessarily the best strategy, because I think ultimately, in my personal opinion, total return matters. So whether you're investing for income, if you're not necessarily keeping up with the index that you could be investing in from a passive perspective, then you're actually a little bit behind the game. So it's important that, from my personal strategy, that yes, while dividend investing is helpful, and you can choose through certain criteria, yield and other types of factors, the companies you want to invest in Canada and maybe some in the US, the fact that you're potentially ignoring through concentration risk or other types of factors, you're ignoring a whole world of 97% of other stocks, I think is a little bit nearsighted. So diversification is super important, I think, for most investors. But to Henry's point, I mean, if he's comfortable with the 12 stocks that he's owned, he feels very confident in that collection of concentration, and honestly, he's meeting his needs, that's great. And same with Adrian, if his approach through the fund approach and the yield approach is working for him and it's meeting his needs and Erica's needs, then that's great too. I just think that for most investors, diversification is a bit of a hedge to basically spread your investing risk around for things that you just can't see coming. And any of us would be probably foolish to say that we could predict what next week, next year, or the next 5 or 10 years holds.
Right. Yeah, and that's a good point you make there, Mark, because I know, even if you think of the idea of correlation, you talk about that if people have watched any other webinars on, portfolio management, that kind of thing. I know I don't think Henry's doing this. I think he's got some diversification, but you want to be careful not to invest in all bank stocks because they all pay a decent dividend, or all utilities, like you were mentioning earlier. Like, you don't want to be in all one area, because a rising tide raises and lowers all ships, right? You could be in a situation where you're losing a lot of your portfolio just with that same sector. Does that make sense?
Yeah, absolutely. There's absolutely correlation risk and other types of risks that investors may not fully understand until you're actually in the situation to understand it. And so diversification is essentially that hedge to spread your risk around maybe other sectors, countries, companies, and potentially asset classes, fundamentally just to meet your goals. And that's a very personal choice.
All right. Yeah, good thing for our audience to be aware of. And thanks so much for all of you for filling us in on your styles. Just a quick note to our audience, you can find out more about each of the panelist styles in the past appearances that they've done with us. They're available in the Learning Center on Webbroker and on TD's YouTube page. So if you want to look at more about the styles of the panelists, you can definitely check it out there. So we're going to keep going. I've got you guys on the hot seat for a little bit longer, and then we'll go to some of the questions that we have from our audience. You somewhat eschew traditional investing wisdom like the portfolio diversification, rebalancing, and capital appreciation. Can you take us through your thought process on that?
Well, I sort of explained it before, but really it boils down to, instead of diversification, it's really you want to concentrate on quality. And, everybody tells you should be investing for the long term, that you shouldn't be look for companies with wide moats, on and on. But if you can identify a quality company, one that you recognize has paid and grown their dividend, they have a long history of surviving various economic troubles, recessions, market crashes, but if the company provides a service and a product, that is required and will be needed looking forward, going forward 10, 15, 20 years, then, that's what I want to do. I want to concentrate on just quality companies. I don't want to, certainly I could earn more income if I invested into some higher yielding stocks, or if I expanded into maybe some REITs. There's all sorts of higher yielding companies, but you add a level of risk to those investments. So my intention is to stick with the best companies I can find, and I know through personal experience that every company is going to run into trouble at some point, but can they work their way through it? Do they have the resources? They may end up with a period where their earnings, are higher than, the payout ratio is 100% or 120%. But, quality companies, they have the resources, the cash flow. They may even have to borrow money to, cover their dividend. But, they recognize that it's important that they maintain the dividend policy that they followed for years and years. And certainly a company can't have a high payout ratio for 4 or 5 years, or borrow money for long periods of time to cover the dividends, but most quality companies don't do that. They'll have, short periods of financial trouble or economic difficulties, but they'll manage to rise above that. And in the long term, if you stick with them, you'll come out ahead. And as long as they don't, cut the dividend, that's really the key. And even with some of the quality companies, where they've cut the dividend, you may look at the company and say, well, it was a good idea. They should have done that. So I would stick with them. I wouldn't necessarily sell if I really believe that the company is just going into a short-term financial difficulty. And, I could spout a couple of examples, but, we don't want to talk about specific stocks. But so my idea is to identify quality companies, and I'll stick with them through thick and thin, unless something really serious happens. And, like I say, I've been retired for 15 years. I've owned those stocks for 15 to 20 years. We ran through the financial crisis. They had the COVID situation, and they have the situation right now where several of those quality stocks are, providing fairly high yields, much higher than their average yields. And for me, that's great. I'm not concerned about those quality companies because I believe they'll be able to ride through whatever difficulties or whatever markets believe that they're having difficulties with.
Well, that's a great point. And I know Mark is more on that hybrid side where he's a little bit on the diversification end and, somewhat could be some individual stocks. I saw on his blog recently him saying, I don't know the exact wording, but it's not easy for these companies to consistently always pay these dividends. So if they have that track record, then you can have a little bit of comfort in knowing that they're probably going to continue with it. So I like your thoughts there, Henry. And just flipping on the flip side, this is what I meant to ask Adrian earlier. So a follow-up to you, Adrian, on that point. Why do you care about diversification and rebalancing your portfolio if you're only concerned about income like Henry is? What's your differing opinions there?
Yeah, that's a good question. And what I will say, and a lot of newer investors do have trouble with this because, once you start investing, you get hit with a lot of information, a lot of different opinions, a lot of people doing different things. And this panel is just a perfect example of three guys who've been investing for a long time and all have different priorities, right? Our priorities are different. So for some people, diversification is not important. For some, it is important. For some, like Mark, the key is total return. For Henry, I don't think it's total return. It's more the growing income and the quality of the stocks. For me, it's cash flow. So I think where a lot of people need to remember, and they're seeing even Warren Buffett. Like if talking about diversification, he famously said diversification makes no sense. Why is he saying that? You always hear diversification is a good thing. Well, diversification really will only get you pretty much average returns, because if you're diversified, you have everything, you have the whole market. whether it's sector or region, you'll pretty much have the average market return. And for some people, that's fine, and that's their number one priority. Warren Buffett famously said, diversification is a hedge against ignorance. If you want nothing bad to happen to you, you stay diversified. So everyone has different priorities, right? If you're trying to beat the market, you're not going to be diversified. You'll never beat the market, right? So it's really about the priority. For me, diversification makes sense to a certain extent. And there's another thing is that what is diversification? There's several layers of diversification. There's sector diversification, there's regional diversification. In my world, in the income world, where you're investing in covered call ETFs, there's covered call strategy diversification, right? So there's a lot of diversifications. The goal is really to try to figure out what's best for you. There is no, I always try to tell people there is no what's the best in investing. You got to try to figure out what's best for you. That is the key. Right? I will never say my income investing style is the best, but it's the best for me. It's maybe not the best for Mark or the best for Henry, and that's okay. The whole point is to take the ideas and see what best fits your style, your personality, your mindset, your lifestyle, your goals, right? So I personally like diversification.
Yeah, I like your...
Oh, sorry, sorry, go ahead.
I was going to say, I like your reference to Warren Buffett. I've heard that one too. And, it's interesting because he's saying if you're him and you've got these resources and this knowledge, then you want to maybe go into one or two stocks or a few number of stocks. But for the average investor like us, yeah, it's just not realistic to put in that time. And
guys like him, they're trying to beat the market. But he famously says that his own family members, and for what he suggests is just go with the S&P 500 for most people, for average investors. So depends on your goal. Depends on your objectives. Some things are more important to some people than other things. So it's all about that.
Well, that's a great segue too. But before I run into the segue, I was going to go to a question for Mark. Just to remind everybody, there is a poll on the screen, so don't be afraid. You can click on that, read through those. What we want to do with this is this is a compilation of many of the questions that we've gotten from our audience. So vote on what you'd like to see as the your favorite question in here, which one resonates with you the most, and we'll take the top 2 or 3, whatever we can get to. So we'll see if we can answer those, but vote on those for now. And just one last question before we get to those audience questions for Mark. Mark, with that idea or that segue of diversification, and balancing your portfolio and individual stocks and so on, how much time and effort does it take? So in your situation, does it take a lot of time and effort?
Yeah, I mean, not really. I mean, my basket of Canadian stocks is a little bit more than Henry, probably, closer to the low 20s at this point. But, I've decided to, take those tall stocks, some of the telcos, utilities, lower yielding, higher dividend growth paying companies and financials. And I just stick with a fairly simple sector allocation. It's not that much different than the TSX 60. I heard Adrian reference that before. That's one index that many Canadians can decide to invest in and follow, and you're going to get your dividends and your capital appreciation from TSX 60. There's obviously the S&P 500 index, but back to Canada specifically, I've decided to basically unbundle my Canadian dividend ETF or my TSX 60 index and just build my own collection of stocks. Again, we've said it's not necessarily for everybody, but that way I basically have very limited, if any, ongoing money management fees. I am my own advisor. I make a couple transactions a year. In terms of rebalancing the portfolio, I kind of look for sectors out of favor. I saw oil and gas as an opportunity, to be honest. Coming, midway through the pandemic, it was totally beaten up. It was a little bit wild to me to think that, oil and gas as a particular sector was not needed anymore. The valuations did not make sense to me, and so I moved a bit of money that way. So I do like to buy, stocks and sectors out of favor. And you can kind of see that through the price depreciated values or, higher yields like we're seeing now. And Henry alluded to that. You're seeing high yields creep up for some companies or sectors. And so that can be a signal that it could be, air quote, time to buy. So I don't really monitor my portfolio very much. I look at the odd quarterly statements, of course, but I actually don't do a lot of research. Most of my portfolio has been on autopilot for years. The dividends come in, I reinvest the dividends in certain accounts, and I basically just live my life. And then more and more, I'm indexing a little bit beyond Canada just because it's lazy and it's easy, and I pay zero to low money management fees to do so, and I can do other things with my life and my time. So yeah, not a lot of portfolio maintenance now that things are basically up and running and on autopilot, and I love it.
Oh, that sounds great. So we've got the poll up on the screen. Thanks so much, Mark, for that answer. And I think some of these questions will be related to what you guys have talked about so far. But we've got the answers up here, and the winner so far, it looks like a clear cut winner at this point is. Would you mind speaking a little about withdrawal strategy? So, for instance, Adrian states he is living off of dividends and not touching capital. What does he intend to do at retirement? RRSP conversion time. So, I'll throw that one out to you, Adrian, because you did it did mention you in that question, but then maybe we'll see if anybody else wants to answer that one afterwards as well.
Yeah, sure. It's a good question, and it's a question a lot of people have to think about, right? The withdrawal strategy, that dreaded withdrawal strategy. And this is where I think my style shines, because I'm all about never touching the capital, just live off the interest. So right now, my RSP, my wife's RSP, we're not touching that. Nothing's coming out of it. It's just all the distributions, all the dividends are being reinvested, either drip or manually. I mean, the withdrawal strategy is very, very easy. And I do a lot of coaching sessions with people who are about to retire, and this is a big selling point on why they love this strategy. So, just live off your interest. Very, very simple. So my whole thing is I want to spend the least amount of time in my life looking and managing my investments, like even much less than Mark. And if you want to spend more time stock picking and sometimes transitioning out of sectors back into sectors, 100%, that's completely fine. Some people like to do that. That's completely fine. I personally believe whether you're growth, dividend, or income, you might as well just stick with the indexes. Like Mark mentioned, the TSX 60, which captures all of the Canadian market, for example, the management fee is 0.08%, which means you're paying 80 cents for every $1,000 that you invest. So for me, that's well worth it just to get the overall Canadian market. So going back to the RSP question, though, because it was about that, I was just talking about it with my wife the other day. We're like, yeah, what are we going to do? Because we don't need the income now. Our main portfolio pays all our expenses. So we're probably going to turn it into RIFs relatively earlier, maybe when we hit 50 or 55, and just kind of stick with the same strategy of just extracting the government mandated minimum percentage, which is it's only like 2 or 3% at 55, and it goes up every year you get older. And again, just like the main portfolio, just live off the income and try to have the best quality of life possible. So I would say that the withdrawal strategy is very, very easy as an income investor for us anyway. That's how we look at it.
All right.
Hopefully that answers
Thanks
the question.
for that. And no, that helps a lot. Thanks, Adrian. And actually, in the essence of time, what I'll do, I'm going to go to the next question because we want to get as many as we can in here. I'm going to throw this one to Mark because I know Henry, your portfolio is usually that smaller basket. But Mark, what would you say? What's a good portfolio and asset allocation for the current environment? Do you have any thoughts on that?
Yeah, I mean, I'll be quick because we definitely want to get to a lot of other questions in the next little bit. But I don't know if there is a perfect asset allocation. I think what you need to think about is certainly your overall financial plan. What, like we've talked about a little bit. What are your goals? What's your whys? Like, why are you investing? What does all that look like? Certainly, you may want to think about your beyond your whys. Then obviously look at your equities, your mix of cash and fixed income, if those kind of three major buckets are important to you. But right now, I mean, certainly, I have to say it, like tech has been pretty frothy for a while, right? And it's been on a run. So, and we're looking at the U.S. market. What is the U.S. market now? 26, 27% tech if you look at the broader U.S. market. So there may be value in Canada, to be honest. And I'm not saying that in terms of anything that I'm personally doing, but I was thinking about energy myself a year or so ago, and I'm still thinking about it a little bit. So I don't have a perfect answer for you. I would think I would focus on your whys. I would focus on behind your whys, your allocation that you need to meet your goals. And then beyond hopefully meeting your goals, you can potentially be a little bit strategic from there.
All right. Yeah, it's going to be unique for everyone in terms of the risk tolerance and other things. And you gave some other stuff earlier. We talked about that acronym, the TULF or TULF. Those are things to start with. But yeah, there's always going to be all kinds of asset allocation mixes for sure. So no, thanks for answering that, Mark. I appreciate it. And I want to go to a question I have from Janet. So it's saying Henry appears to be 100% Canadian stockholder. What percentage U.S. holdings do Mark and Adrian hold? So we'll get to you in a second here, Henry. We'll get to you with another one. But what do you guys think, Adrian and Mark? If you can answer that, that's it's up to you. If you don't want to, that's okay.
Yeah, sure. I could go first, Mark,
Sure.
if you don't mind. So
Yeah.
I would, as an estimate, just off the top of my head, I think I'm over 80% in US stocks, I would say. So the way I look at it, this is just my personal opinion. I always try to look at things from a bird's eye view and an overall view. So the US stock market has consistently outperformed everybody forever. So when I look at that, I'd rather invest long term in the US stocks. Now, another thing that's very specific to my particular case is that I am currently a Canadian non resident for tax purposes. So taxes are, it's very relevant because I know a lot of Canadians will hold the Canadian stocks in their non-registered accounts and their TFSAs because of the tax benefits. But in terms of performance, I think the US is king and probably will be. So I have approximately 85% overall in US stocks overall, and the rest in Canada. In Canada, I'm very concentrated. What I do have in Canada, in the banks, in the financials. A bit of energy as well.
Okay. And then what about you, Mark? Just real quick, what's your your balance?
Yeah, Adrian hit on a good point. I've had my wife and I've been very fortunate to have our RSPs topped up for a few years. Gosh, love the TFSA. It's been a gift to every adult Canadian, and I say that on every webinar. But we also, to Adrian's point, we also have taxable accounts. We've been investing in taxable accounts for a while because the RSPs and the TFSAs are maxed. So I do have a stronger bias to Canadian dividend paying stocks in the taxable accounts that we own. So my allocation is, I wouldn't say it's the inverse of Adrian for sure, but I'm probably not quite there to about 30% US, and I probably want to inch that up quite a bit higher over time, to be honest. But that's because I've been taking advantage of the taxable account because RSPs and TFSAs have been full. So yeah, it's a great home for Canadian stocks or Canadian stocks that pay dividends or even lower dividend paying companies. But yeah, if I had to kind of summarize where I'm trending over time, maybe semi-retirement, full retirement, it'd be nice to have like a 50-50 mix, 50 Canada, and then maybe 50 around the rest of the world. But that all depends on my income and my taxation needs. So it's very nuanced for us.
All right. Yeah, no, I appreciate you guys describing both those different approaches. That's great. And Henry, I know I told you I'd get to you. We have a question from Sandra saying, Henry, does your 15 to 20 stocks that you own in your portfolio follow that TULF category, the TULF, the telecom, utilities, and so on? Does that follow that?
Yeah, I'm basically invested in 4 sectors, and not evenly, but it's fairly even. And in fact, it's changed in the last couple of years because we realized that we were earning so much income, and the vast majority of it was in our RIF accounts. And it finally dawned on us that we were never going to draw down those RIFs to the point that we wouldn't be taxed at 45 or 55% when we finally had to pay the taxes on them. So we decided to start closing out our RIF accounts. And so we started drawing out much higher withdrawal rates rather than the 7 or 8% that was required. I think we were taking out like probably 18% or 20% every year. and we were paying the taxes. Some of it was going to our tax-free savings account, and then we distributed the balance to our kids or grandkids, so that our asset allocation, or at least the sectors that we're invested in, started to shift because so much of our investments were in our RIF accounts, and we were selling those off, and then not necessarily moving them into our other accounts. So, but we still are in the four sectors, and pretty much, I guess, financials, utilities, pipelines, and communications.
All right. No, that's helpful, Henry. Thank you so much. And I know, just in the essence of time, I'm going to go. We did the vote on the poll there, so we have a couple more questions. We'll get to those. I apologize. I forgot to mention earlier to everyone, these guys did agree they'd stay 15 minutes late. So thanks so much to you guys for agreeing to stay a little bit later. We thought we might have so many questions we may not be able to get through in that hour, but we'll go through a couple more, and then we'll wrap it up with some closing thoughts from the panel. But looks like the next winner on the poll was, in today's high interest rate environment, what is an acceptable yield in your view these days? And I really like this question because I was thinking of asking something like that as well too, where a lot of people seem to be just moving to those high yield GICs and things like that. What's your opinion on as a good rate yield for you guys with your strategy? Okay,
Yeah,
let me
like
actually. I'll have to pick who I want this one to go to. How about we start with? You're on the bottom of my screen, Mark. I'll go for you first.
Yeah, I mean it's subjective. I think it depends on your goals. I think it depends on your risk tolerance. To be honest, I mean, famously said by a very wise investor. I mean, diversification, again, free lunch and all those other things, but the investor really only needs to take on the amount of risk that they need to take on. So for some people, they don't need to be heavy right now into equities. They may decide to shift into higher yielding GICs, cash alternative ETFs. Things are paying 4, 5, 6%. And if that's meeting their income goals and that's meeting their long-term needs, then I think that's more than fine. I would be mindful and careful, and we talked about this a little bit, that certainly chasing any sort of yield is a bit of a danger sign, whether it's individual stocks or through leverage strategies. So I would be cautious to most DIY investors that chasing yield is not necessarily great, but in terms of a higher interest rate environment, you can absolutely take advantage of GICs and other types of products out there that are paying a lot more than they used to. So.
Okay. And I'll go to I'll do the other question with you, Adrian, after we get through Henry's response to this one. What do you think, Henry? Is there a certain yield you had in mind for this day and age?
Well, first off, I'd never invest in any fixed assets, regardless how high the rates go. They could go to double digit, and I still wouldn't invest in them. But as far as the yield for the stocks, when you invest in quality stocks, of course, they all have a different average yield, long-term average yields. Some will be 4%, some would be 3%, some would be 2%, or even less than 1%. And so what I look at is really the yield difference, the current yield compared to the yield or the long-term average yield of that particular company that I'm interested in. And, I don't like, in most cases, I won't invest in a stock that has a 3 to 4% yield difference. I think that's a little bit too high. There are exceptions to that. And in fact, the market today, I think that I'm invested in a few that are 3%, have a 3% yield difference. But normally I would stick to 1%, maybe 2% higher above their long-term average yield. And again, it depends on the individual stock. If I buy a low yield stock, well, 1% would make it maybe a 1.5% yield. But if a company has an average 3.5%, I would like to see it at 4% or 4.5%.
Okay. Well, that's a great answer. Very specific there, and I like those guidelines you have there. So we want to get to this last question. I'll throw this one to Adrian, and it's a little bit long, but I think it's a good one for sure. It's just saying, regarding dividend income, I am finding that capital gains or dividend tax credit does nothing for me inside the RSP or the RIF. because minimum required withdrawal funds that come out are taxed as income. So when you're withdrawing from those retirement accounts at the max tax rate, it's okay in margin or TFSA. Am I right to think that? What do you think, Adrian?
Yes.
Yeah,
It
so definitely in
doesn't
agreement.
matter. In
And
the
I think what they're
RSP,
talking about is just that. Yeah, go
it's
ahead.
a registered account, so you don't get dividend tax credits in the RSP.
Right. So it's going to help them in those other accounts potentially. No tax in the tax-free savings account, but in your margin or cash account, you could benefit from that Canadian tax credit. Is what I think they're alluding
Yeah,
to.
it's really for the non-registered,
All right,
where you
perfect.
have the
So
biggest
yeah,
bang
they're on
for
the
your
right
buck.
track.
Yeah.
Excellent.
Well,
They're
he's
on the
right.
right track on the thinking.
He's right.
And we're at time. We're almost quite a bit at time. We got a couple minutes to go. I was going to get some closing thoughts from any of you. I'll start with Adrian. Do you have any closing thoughts on just our overall topic with the panel today? We had some different perspectives, which I think are good for everyone. What's your final thought?
Yeah, so I want to thank you for hosting it. Thanks to TD for hosting good webinars like this, educational, where people could see different perspectives. I think investing is 100% subjective. That would be my message to people watching. You got to find what's best for you. All three of us are different investors here. I would consider myself a pure income oriented investor. I think Henry is more of a defensive dividend investor. And I think Mark is probably a total return investor, right? So everyone has to figure out what their priority is and use investing as a vehicle to get to those goals and the priority. So whether it's growth, whether it's dividend, whether it's income, I think all three work long term. As long as you have a long term mindset, I think that's important. And just figure out what's best for you. And it was a pleasure to be here.
Oh, that's excellent. Thanks so much, Adrian. What about you, Henry?
Yeah, that's a great comment there, Adrian. I think that one of the most important things is someone should take the time to learn about investing before they actually jump into it. And of course, they should try to get into investing as early as possible. A lot of people say that it takes a lot of money before you can live off your dividends or live off your income. Well, it really doesn't. If someone starts early enough, and in fact, I was just playing with numbers. If someone started at age 40 and invested $3,000 a year in a tax-free savings account and could never increase that amount till they were age 65. So they just put in $3,000 a year, say a married couple. Well, at the end of, or at age 65, they could probably generate around $20,000 of dividend income at age 65. That's not a lot of money. But, for a low income family, add $30,000 for Canada Pension and Old Age Security, and suddenly you're at, $50,000 of tax-free income. Well, they would also qualify for the Guaranteed Income Supplement, which is another $15,000. So suddenly they're earning $65,000 of tax-free income. Well, almost a lot of people can live off $65,000 a year, a family, a couple. So it doesn't take a lot of money. What it takes is decide what strategy you want to invest in, start as early as you can, and stay with the strategy that you decide upon.
All right. No, great words, Henry. Thank you so much. And then, Mark, what would you have to say just to close us out today?
Yeah, I can't think too much more, but I'll take a maybe more focused and maybe blunt stance. Just save. Like, learn about the power of the TFSA, whether it's an income strategy, maybe it's a dividend strategy, a total return strategy. Just save. Learn about the power of compounding in a tax-free savings account. The RSP may make a lot of sense in your asset accumulation years. I saw some of the references to asset decumulation in the polls. You have time to worry about that later, but wouldn't it be great if you had a maxed out TFSA and a fully maxed out RSP, and then you can worry about tax problems in retirement? I mean, wouldn't that be a phenomenal thing to be annoyed with, right? So just save, learn about the power of registered accounts first, and then if you get in the good fortune of investing in a taxable account and you worry about more tax issues later that we've alluded to tonight, so be it. But what a great problem to have.
All right. Thanks so much for those comments, Mark. And I want to thank everyone. We're going to have to leave it here. A special thanks to all of our panelists for joining us today. So we had Adrian Starinieri, founder of the YouTube channel Passive Income Investing. We have Henry Mah, founder of the investing blog Your Ever Growing Income, and Mark Seed, founder of the personal finance blog My Own Advisor. So, and of course, thank you so much to our audience for tuning in. Remember to check out our entire schedule of events during Investor Education Month. That's going to be at td.com/IEM, a nice short one to remember. And register for our upcoming live webinars and master classes as well. So we have classes that are similar to this that are a little bit more interactive. Plus, check out our library of on-demand content available in the Learning Center and on our YouTube page. So thanks again, everyone, and we'll see you all next time.
Great.
Take care. Talk to you.
I enjoyed it.
Thank you.